Let's get across the market open now. Mark Gardner joining us from MPC Markets. Mark, happy Monday to you.
Happy Monday.
Let's first start where we finished on Friday. Obviously, all eyes are on the key non-farm payrolls out of the States. Look, certainly a higher print there, but also perhaps a bit of a surprise the unemployment rate ticked up.
Yeah, it ticked up to 4.2, but realistically, they're still ticking over at 230-odd thousand jobs a month. Surprisingly, that for some reason increased the rate cut bets, which is, super counterintuitive considering that's, that small tick up in the unemployment rate realistically doesn't justify more rate cuts, to be honest. We had Fed Bostic's, she came out and said over the weekend as well that, inflation wasn't under control yet. Was a little bit concerned about it potentially heading back up again. So, while they've got a 90% number on there at the moment, I can realistically see them, not going again this year and then possibly waiting, into late first quarter next year, to be honest, because the economic figures don't remotely justify more rate cuts at this stage. They've done a 50, they've done another 25, and the US economy is showing pretty signs of pretty good resilience there at the moment. So. But they seem to be picking out of every number, what could possibly be the weak part to get. And you can't just wish for a rate cut. I mean, at some stage, the central banks have got to essentially look at the numbers and decide whether it's prudent to be doing that. And at the moment, in any normal circumstances in history, this is not a rate cut environment.
Yet the market is still at record highs. We saw that with the S&P and the Nasdaq on Friday. If the Fed actually doesn't cut, what's the likely market response, do you think?
Well, I'd say it'll probably pull back for momentarily, but I don't really see much happening until we get through this inauguration. And because everything seems to, everything that's been thrown at this market this year, the market seems quite bulletproof at this stage, and nothing seems to be able to derail this rally. I mean, this is the best two-year rally since the 1930s. Certainly, well, outside, I think 96, 97, but we were, rates were coming down from 17% to 3% at that stage. I mean, that was fairly justified. This is by far and away the best two-year rally we've pretty much ever had in a hiking, most of the start of it was in a hiking environment. And, so I'd say probably we just drift into the end of this year, but we're getting very close to, one of the better years we've had in quite some time as well. And then I think we'll probably start the new year, with investors rebalancing portfolios, etc. Because I don't really see much more than a single-digit gain next year, and I think it'll be quite a bumpy ride over the course of the year as well. Because as I said, the rate cut expectations are going to have to start to be unwound because. You don't just get to wish them to be true, and with Trump coming in. There'll be a fair bit of fiscal instability and potentially tariffs, etc., which is short-term inflationary. And I think that if I'm sitting on the central bank or on the FOMC, you probably just want to wait and see what he actually puts into play there, rather than be trying to preempt anything that that administration does.
Well, I mean, certainly investors looking forward to those tax cuts that Trump is promising. I mean, is the US market where you want to be? I mean, how would you position? Are you still seeing opportunity locally?
Yeah, definitely. I mean, in the resources sector, as we've seen with the sector performance over the last 12 months, the IT and financials have basically held this market up. I think the big four banks are responsible for 2/3 of the total rally in this market over the last 12 months. IT is up something around the IT sector is up somewhere around the 68% mark. So resources and energy were down, and I think what we'll see with China is that stimulus will start to bear teeth at some stage, and China will likely have bottomed, and there is a lot of value sitting in that resources sector at the moment. Very low PEs, very low forward PEs. And if we are going to have this Goldilocks scenario play out where we're going to still, get global growth over the next 12 months, that's probably where the value sits as it stands at the moment. I can't really see, the tech sector or the finance sector, having another year like they've had this year. It's statistically highly unlikely, and I think you just start to look for value in other areas of the market, particularly if we don't see those economies start to slow down like like what everyone's been predicting.
Any particular stock? I mean, you're looking at resources opportunity there. Any particular stocks you're sort of favouring at the moment?
Look, I brought up Fortescue a couple of weeks ago, or on the COB, but just mainly because with the BRICS, with the threat of the tariffs against BRICS, basically the next 6 nations on the iron ore exporters is basically Britain, Russia, India, China, and South Africa. So I think we're going to be in a really fortunate position of being the friendly partner with the US for a lot of the resources they're going to need. And that was just one that, being a pure play. Obviously, the growth companies will still do relatively well. Quite liking the likes of Clarity's pull back quite considerably. It looks fairly good leading into next year, whilst it's not going to be profitable necessarily. And Polynovo in the biotech sector is not too bad either. So, there'll still be pockets of those growth stocks heading higher, but I think you've probably seen a lot of the good news play out for some of those big names. Pro Medicus, WiseTech, etc. They're trading it. They would have to absolutely shoot the lights out to even come close to what their forward expectations suggested by the share price. So, whilst it's not necessarily the company's fault, it's the market that's pushed them to those higher prices. I don't think you can, you're unlikely to see when earnings roll around that them justify those inflated prices. And we even saw with the likes of WiseTech, they had an investor day. I don't think I've ever seen them down on an investor day. And they've obviously been distracted by the turmoil that they've had in the press, etc. as well. So there'll be and they're rolling out new projects. That's the wrong time to have management distracted. So yeah, I think we'll have similar to when we had I think 2 years ago, the industrials was the worst sector in the year, and I think the likes of James Hardie were absolutely smashed. Following the next year, I think James Hardie ended up being one of the best performing stocks of the year. So it is quite often the most beaten down sector. The following year can be one of the better performing, and that's certainly in the materials and the energy sector at this stage.
And Mark, of course, we do have the Reserve Bank decision tomorrow. Is that likely to move markets at all, do you think?
I wouldn't have thought so, no. And we've got employment on Thursday as well. We are showing resilience in the economy at this stage. I can't imagine leading into, we'd be looking at an election obviously early next year as well. So there'll be fiscal stimulus, etc. So I can't really see the RBA finding any reason for to be cutting rates due to the Aussie economy. We've always been late Q1, Q2 next year. I'm sort of even shifting back to do we even get it at all, to be brutally honest. We didn't hike as much as what everyone else did, so it really is the rest of the world coming back to us. I think we've got Bank of Canada and ECB as well this week. So they're expecting 25, and I think the ECB might be 50. Very different sort of scenarios over there. There's genuine economic weakness. So I would expect that there won't be much out of that. It'll be more of the same from the RBA, and then we don't really get a meeting till February after that. So, and US inflation numbers this week, Wednesday as well. If we get any sniff of inflation in the US, I think that really starts to drive bond yields higher and probably puts a bit of a cap on the market as it stands. So not expecting too much into the end of the year realistically after that unseasonably strong sort of September, October.